which is 73.5% of the net revenues, grew by 21.8%, and that took them from 6,388 crores to 7,781 crores. That's 21.8% growth. And that came on the back of an average asset growth of just over 20%, 20.2%, and a net interest margin of 4.4% as against 4.3% in the corresponding quarter of last year. The other income, which is the balance 26.5% of the net revenues, grew by 14%. The largest chunk of the other income tends to be fees and commissions. It's roughly 70.5% of net revenues, of the other income, and fees and commission growth was 15.5%. Moving on to OPEX, operating expenses for the quarter were 4,769 crores. They grew by 19.2% over the corresponding quarter of the previous year. The cost to income ratio was roughly flat at about 45%. After provisions and contingencies and tax, the net profit growth for the quarter was 20.2%, and the actual net profit for the quarter was 3,238.9 crores. Moving on to some of the balance sheet numbers, the total balance sheet size was 7,55,000 crores. That compares to 6,29,000 a year back and just over 7 lakhs as of March. Total deposit growth was 18.5%. So our total deposits as of June were 5,73,000 crores. If you look at within that, the savings account growth in particular was healthy at 22.2%, which of course took the savings accounts to 1,52,000 crores. Current account growth was 13.7%, and the CASA ratio as of June, because of an extremely strong fixed deposit growth as well, was 39.9, just about 40%. Advances growth on a year-on-year basis was 23.2%. Our advances were 4,70,000 as of the quarter end, as of June 30th. And if you look at it from the way we look at the businesses, then wholesale and retail growth was 23.7% for wholesale and 24.9% for retail. If you look at it from a Basel II classification point of view, then both growth rates were roughly equal at about 24.5%. So it's not too much of a difference there. Our distribution network as of June was 4,541 branches. That's against 4,101 branches at the same time last year in June. 54% of these branches are now in semi-urban and rural areas. Finally, on the asset quality front, gross NPAs were at 1%, 1.04. Net NPAs were at 0.3. Total restructured loans at 0.1%. Capital adequacy on a total basis was 15.5%, and Tier 1 CAR was at 13.3%. So those were some of the key numbers, and be happy to take any questions.
The first question on the loan growth, very healthy this quarter, or the fourth quarter is the strongest for you.
Sure.
So this is perhaps a little slower than the fourth quarter, but what were the key drivers in terms of the retail and corporate growth, with segments, especially CV, if you could highlight a little more how that can be?
Sure. So you're right, on a year-on-year basis, as I said, both pieces grew roughly 23-24%. On a year-on-year basis, some of the strongest growth on the retail side has come from the usual products. I think we had personal loans year-on-year growth, which was the strongest. We had credit cards, we had home loans. Most of these are in the 20s. Home loans grew by 25% year-on-year. Business banking growth year-on-year was about 19%. Credit card growth year-on-year was about 26%. So those were the slightly larger or faster drivers. CV growth, which you asked in particular, both CV and auto loans grew year-on-year at about 18.8 and 18.9%. So just a shade below 20%. And you're right that when you look at the growth from a March which is always a peak period for both peak quarter for both wholesale and retail. In particular, this year in March we had a spike in the corporate loan growth towards the year end, which has corrected for itself. But on the corporate side, most of the growth tends to continue to come from working capital and medium term loans. We've had a little bit of term lending, which is really on the refinance side rather than completely new greenfield projects. But again, otherwise, probably a well-distributed growth across both our wholesale and retail businesses.
Very slight margining in your worsening in your asset quality, sir. Could you just tell us where that came from?
Sure. So if you look at the gross NPA numbers, I mean, we've if you really go back to an extended period over the last 25-26 quarters, we've been in a range of about 0.91 and 1.4 at peak. But certainly in the recent past, we've been somewhere around that 1% level. So yes, there has been a few basis points increase. Some of that, about 40% of that, came from the SME, the business banking portfolio. We had a couple of basis points each from a couple of retail and other products. So there really isn't any one chunky segment or a business which is contributing to these 8-9 basis points of increase. But in absolute terms, at 1.04, I think we are still very comfortable. You always, of course, have to look at the asset quality piece in relation to the mix of our loan book. And with clearly a little over 50% in retail, and each product in retail having a certain expected loss, and which gets priced in and which is really there in our 4.4% net interest margin, clearly I think the risk reward is playing off. Also, as we for the same products go into deeper geographies in terms of semi-urban, rural, some of the segments which qualify for priority sector, there will always be a few basis points movement across quarters. So that's where it is.
Your provisions grew by 30% on quarter and 18% on year. Have you provided in excess of the growth in GNPAs? Is this?
So we do have a small floating provision that we have made in this quarter as well. But overall, I think the coverage ratio remains at 70%, and therefore the provisions that have been made are largely to ensure that we have a very healthy coverage on our NPLs.
Any sale to ARCs in this quarter?
No, we didn't have any sales to ARCs.
Just some outlook if you could give on your margins. I mean, traditionally you maintained it around these levels. What were the scope for expansion do you see through FY17?
So I've traditionally said that we don't have a guidance on any one number for a quarter or for a year, but if I look at the historical range, we've been for the longest time between around 4% to about 4.3. In a sense, perhaps this quarter's 4.4 is sort of bursting the upper end of that range. Some of that has come from the gradual change in mix which we've had between wholesale and retail. As you're all aware, as retail as a component or as a proportion of the total loan book increases, the yield is slightly higher, and that helps the net interest margin. Obviously, the operating and credit costs which are factored into that net interest margin are also slightly higher. I would just leave you with the thought that there are movements in both directions, some caused by the declining yields as more and more players focus on retail and the competition there is intensifying. General expectation that lending rates are gradually but certainly coming slightly lower. Both of those do result in slightly lower yields. On the other hand, deposit costs have been coming down, but there's always a lead and lag, so you have sort of pressures in both directions there. So combination of what happens to our loan mix, what happens to the competitive environment, what happens to the repricing of deposits and loans, I would still believe that our net interest margins remain range bound in the 4 to 4.3, 4 point range.
So which are the new segments that you think will be the main growth drivers going forward for HDFC Bank?
So to be fair, there isn't a large segment that we are not adequately present in, right? So in that sense, it is a range of businesses across wholesale and retail. On the wholesale side, we have a large corporate, which is a corporate banking business, an emerging corporate, which is a middle market business, and then you have business banking and financial institutions and so on. And we found that most of these businesses are seeing very healthy growth. You do have some variations, from quarter to quarter, but on an annual basis, we found that each one of these, and we still believe there is a long way to go for continuing to grow each of these segments. As far as the retail business is concerned, some businesses are linked to what happens to the underlying industry. So, for instance, if you look at car sales, I think in the first quarter the car sales were up about 7%, while our car loans have grown by about 18.8%. So, obviously, there is a value issue in terms of the mix or the price of the cars, and of course, some gaining in market share. The CV business, again, numbers have looked up a little in terms of truck sales, and again, there we've seen an 18-19% loan growth. We do believe that both these segments should see healthy growth depending on what's happening in the underlying markets. As far as personal loans, cards, and a few others where we are a market leader, I think we remain extremely well positioned to continue to grow those businesses. I think our focus on those two products in particular has been towards our internal customers, and again, therefore, that gives us a huge opportunity to grow. And you overlay on all of this the fact that in the last couple of years, we've substantially increased our branch network in semi-urban and rural, and of course, we've also been adding some more urban branches in the last year or so. I think we pretty much are looking for most of those segments driving growth rather than one at the cost of the other.
So how much clarifications on margins you said will be range bound? What kind of range are you talking about?
Well, somewhere between 4 and 4.3, 4.4% is, I think, a reasonable margin representative of what we have done in the past, and I think reflecting the mix of our loan book.
So how much of your floating provisions have you used in this quarter? Could you clarify?
So we used floating provisions for the provisioning for the Punjab state issue, which was to be done both last quarter and this quarter, and that was about 120 crores or something like that, which was what was to be made in the last quarter of March, and this quarter is June. And then against that, as I said, we've also created 25 crores of floating provisions.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.